Hello guys, and welcome to this video on introduction to Forex. In this video I'll be walking you through the basics on how to trade Forex. The main goal of this course is to walk you through from being a newbie to a professional Forex trader. This video is brought to you by Forex Passive Income, and our goal is to help you make passive income from the Forex market. Now, before you can be a successful Forex trader, it's quite important that you are acquainted with the basics, the what we call the basic terminologies that goes along with the Forex trading. And that's why in this module we're talking about introduction to Forex. But first we want to start with what exactly is Forex. Forex is just a short form for what we call foreign exchange. Okay, you can also call it FX or currency trading. And it's basically a decentralized global market where world currencies are traded. In Forex, what we trade is currencies. We trade one currency against the other. Just like you have shops that sell grocery and clothes, shoes. But here we are in the business of buying and selling currencies. The Forex market is the largest and the most liquid asset in the world, with an average daily turnover of over 5 trillion. So this making it the biggest financial market in the world. When you compare the Forex to a financial market like the stock, is the biggest and the largest and the most liquid. The currency trade against each other as exchange rate pairs. For example, the euro versus the US dollar. So I've just explained this, that what we trade basically currencies, and we trade currencies by pairing them against each other like this. So let's move to the next, which is the basics. Now in the basics, we're going to start with how is Forex quoted. That's the Forex quoting system. Forex is quoted in pair. Each currency is given a 3-letter code. So below are examples of currency pairs. Now first thing you understand is that each of them are given a 3-letter code representing a country, the currency of a country. For example, EUR is for euro, USD is for United States dollar, JPY is for Japanese yen, Great British pound, that's GBP, and CHF, which is for Swiss franc. I think that's what Switzerland they use. So this is how Forex is being quoted. Here we have what we call major pairs, minor pairs, and exotic pairs. What are major pairs? Major pairs is when the US dollar is pairing with a strong economy. Just like you have euro, which is stronger economy, pairing with the US dollar, this is a major pair. We also have the US dollar pairing with the Japan, which is another strong economy. Great British pound, US dollar. This kind of pairing system is what we call the major pair. We also have minor pairs, which involve other strong economy pairing with each other outside the United States dollars. Like we have the euro and Great British pound, the euro, Australian dollar, the euro, Japanese yen, and the Swiss franc, Japan. Okay, down to exotic pairs. That's when the US dollar pairs against not just the US dollar. Okay, when a strong economy pairs with a weak or an upcoming economy. Just like you have the US dollar with Denmark, the US dollar with South Africa, US dollar with Hong Kong, and the US dollar with Singapore. Okay, just like I explained earlier, it mustn't be the US dollar. It could be euro, Great Britain, or any of this strong economy pairing with this upcoming economy. That gives birth to what we call an exotic pair. Now, still on the Forex quote, let's take it a step further and look at how it's being quoted. Okay, this is an example of a popular quote, the euro and the US dollar, and this is just an exchange rate 1.1161. okay, currencies are quoted in pairs and mostly in 4 decimal place. Apart from the Japanese pairs, you all see them in 2 decimal places. Okay, so basically currencies, they have 4 decimal place. They are quoted in 4 decimal place, just like you can see on a slide. Apart from the Japanese, which is quoted in 2 decimal places. Now, still on the quoting system, you should understand that the first currency, or the first the first currency on the pair is what's called the base currency, while the second one is always called the quote currency. So take note of this. And one important factor you should understand is that the value of the base currency is always 1. The value of the base currency is always 1. So this is to say that 1 euro is worth 1.1161 US dollar. That's the proper way to interpret this pair. 1 euro is worth 1.1161 US dollar. So I'm going to pause and give you 5 seconds because I'm going to ask a question. Now, if 1 euro is 1.1161 US dollar, and the question is the euro and the US dollar, which of these currency have the greater value? I'm going to pause for 5 seconds for you to think and come up with an answer. Okay, if you say the US dollar, you are wrong. And if you say the euro, you are right. So this simply means that, remember we said the base currency is always 1. So 1 euro is worth 1.1161 US dollar. That simply means to get 1 euro, you need 1.11 US dollar. You need more dollar to get 1 euro. That means the euro has more value in terms of in comparing the two pairs. Okay, so that's how Forex is being quoted. Let's talk about pimps. Okay, a pimp refer to point percentage, and a pimp is the smallest unit of price for any currency. Now, still talking about this pair, or taking it as an example, 1.1161. 1 here is the pimp. Okay, so you can see, so I know in some quoting system you always see 5 decimal places just like this. Take note that this last one is not a pip, but rather it's called a pipette or a fractional pip. So when this 1 moves to 2, we say it has moved 1 pip up. When this 1 moves to 0, it has moved 1 pip down. What about if this 1 moves from 1 to 9? It has moved 8 pips upward. Okay, so that's how we calculate price change in the Forex market. It's called pimps. The smallest price change is called a pimps. So let's move forward to the next term, which is lot size and volume. For Forex trading to be profitable, we have to trade it in lot size and volumes. And number of currency units you buy or sell simply in lot. For example, the standard lot is 100,000 units of currency. So if you're trading one standard lot, it means you are investing 100,000 units of that currency. So that's what lot size means. And this chart just makes it simple for you to understand. Like I just said, a standard lot is 100,000 units of that currency, and the volume, which is what you basically enter on your chart when you're buying and selling, is 1. Okay, that's 1 standard. And what you make per pimp is an average of $10 per pimp. Okay, it varies, but in just an average, it's about $10 per pimp. When you're using a mini lot, it means you are buying 10,000 units of a currency, and the volume is 0.1, and you make $1 per pimp. If you're using a micro lot, which for some brokers like Forex, this is the list. Okay, there's a list they allow you to trade with. It means it's a $1,000 of that. 1,000 units of a currency pair, and this is the volume, and you make 10 cents per pimp. Then you go to nano. Okay, since some brokers that allow you to use the 100 units, and basically this is your volume, and you make 1 cent per pimp. So you can use a standard, you can use 2 standard. If you're using a 2 standard to place a trade, which means your volume obviously will be 2, and you'll be making $20 per pimp. So this just determines how much of a currency you are buying at a time. So it's expressed in lot size and volume. I believe when we are on our practical session where we'll be placing trade. I believe you understand how this works. But basically, just understand that a standard lot size is 100,000 units, and what you basically make per pimp is about $10 per pimp. You understand what a pimp is? That's a price change. In time the market price changes a pimp, you make $10. Now let's talk about leverage and margin. These are very important concepts in the forex market. Now, what is leverage? Leverage allows you to trade positions larger than the amount of money in your trading account. Okay, it could be awesome that the fact that you have little capital, but you can trade more than what you have in your account, courtesy leverage given to you by the broker. Leverage is expressed as a ratio. Leverage is the ratio between the amount of money you really have and the amount of money you can trade. Now let's still talking on leverage. Just to give you an example, let's say you wanted to trade one standard lot size of Great Britain US dollar, and we said for you to trade a standard you need about 100,000 units of that currency, which basically you need 100,000 to place a standard. But with a leverage of 1:100, you only need $1,000 to take this position of 100,000 units. So this means you only need a deposit of $1,000 in your account, and your broker multiplies this by 100 and make it up to 100,000. So you can now place a trade worth of 100,000 with just your deposit of 1,000. That's how the leverage works. So the leverage of 1:400, you don't even need up to 1,000. You just need 250 times the 400. You can also place a standard. Before I move further to the next slide, just to let you know that you just have to be careful when you use leverage, okay? Because I believe by now you understand that you can as well use it to multiply your profit. This means that with $250 with a leverage of this, you can be making $10 per pimp, which is what we explained to you in the previous slide when we talk about lot sizes. So that means that with just a 10 pip movement, okay, you have made $100, which is quite interesting. But if you use this kind of leverage, it also magnifies your losses too. This means that if the market moves 10 pips against your direction, you also lose the same $100, okay? And $100 from this 250, that's close to 40% of your capital, and you don't want to lose that on a trade, okay? So that's why you have to be careful when you use leverage, okay? It amplifies your profit as well as your losses. Now let's talk about margin. Margin is simply the amount of money you are required to deposit in your trading platform in order to order and maintain a position in the forex market. Margin is used as a collateral to ensure that you cover any losses you might incur on your position. So what it simply means is that if you want to take a position of 100,000, my 1,000, which my deposit, is simply my margin, okay? So that's your required deposit to take a position. Let's talk about bid and ask and spread, okay? Bid, ask, and spread. So bid represents the price at which a forex broker is willing to buy the base currency in exchange for the counter currency. Ask price is the price the broker is willing to sell the base currency in exchange to the counter currency. So don't be confused. Whenever you open your forex chart, you always see, especially on your market watch where your currency pairs are displayed, you always see two prices like this. One is called the bid and one is the ask. This bid is the market price. That's the price at which the broker they bought the currency, they bought this currency pair. Ask is the price at which they sell to you. So whenever you notice that there's always difference, like in this example here, the bid is 51 while the ask is 64, okay? So when you subtract the bid from the ask, you get what is the broker's commission, what we call spread. So spread is simply the broker's commission, and in this case it is 3. So take note that bid is the market price, or the price at which the broker is willing to buy, while the ask is the price at which the broker they are selling to you. When you subtract them, you get what we call the spread, which is also called the broker's commission. So that's how the broker, they are in business, that's how they make their profit. So I've already said it, that spread is the difference between the bid and the offer or the ask price. Now let's talk about what is bullish. Bullish is used to characterize an upward movement of price. Like if you look at this chart here, you can see it is going up. Okay, so what would describe this kind of chart with in terms of Forex is bullish. It's named after the animal called bull, because bull is, as you know, is an aggressive animal. So whenever the price is going up, we say the bulls are having their way. We also call it the bullish market. Okay, while when the price is coming down, we say it is bearish, named after the animal bear. Okay, bear is used to characterize, or bearish is used to characterize the downward movement of price, as you can see on the slide. Now let's talk about long and short. Long simply means to buy. Okay, when we say go long in the Forex market, it means you are buying a currency, and you're buying with an expectation that the price will rise in value. Short simply means to sell, and you are selling with an expectation that there will be a fall in value. Okay, let's go to our previous slide, and let me just try and explain this to you. So you are, let's say you bought here. Okay, bought here. Okay, so that's what it means to go long. So when you buy here, you are expecting the market to go up, and as the market keeps going up, you are making more money. Okay, you're making more money as the market keeps going up. Okay, so this is what it means to go long. So what happens when you enter a buy position? Because you are buying with an expectation that the price is going to go high further. So if you buy and it's going down, you're not making profit, you're making losses. That's why you need to know the right time to buy. We'll be talking about that when we talk about a strategy. Now for the bearish market, or to go short, it means to sell. You sell in this kind of market when you're expecting the price to go down. So this could be a very good point to sell, and as the market keeps going down, you make money. Okay, you make money as the market keeps going down. So that's what we mean by short. Okay, this is short, while this is long, to go long. Okay, that's to buy and you make profit while the market keeps going up, and short, you sell and you make profit while the market keeps going down. And that's one unique thing about the Forex market. You can make profit on both ways. When the market is going up, you also make profit if you're buying, and if the price is falling down, you also make profit if you are selling. So let's talk about take profit and stop loss. Stop loss is an order you give to your broker to close the position automatically when you are making loss, okay, or when the market is not going to your direction. It's a price at which you tell your broker close this trade when it gets to this price, which is not favorable. While take profit is just the same way, but this just helps you to lock your profit. Let me just go back a few slides. Let me explain this. If I'm buying here, I could as well put my stop loss here. So this would be what we call the stop loss. So it just simply means if this trade didn't go in my favor, I don't want to lose beyond this place, because we said if the price is coming down when you bought or when you buy and the price is falling, it means you're making losses. So around this kind of places, you want to put your stop loss and it stops you from losing further. Okay, and you can also put your take profit above. Okay, you can just tell the broker that, okay, around here, take my profits. Okay, close the trade, I'm okay when I make this kind of profit. The same thing when you're selling. If you're selling, it means when the chart goes down, so when the price keeps going down, you're making profit. And what happens when it's going up? It means you're making losses. So you can as well put your stop loss anywhere above your trade, and your take profit, you can put it anywhere you are satisfied by your profit you made. Okay, so that's basically how take profit and stop loss works. So we always recommend you use a stop loss when you're placing a trade. You always have to define your risk on every trade, and you do that by choosing your stop loss, when to exit a trade when it's not favorable. When you do this, you will never have what we call a margin call. And a margin call simply means it happens when your trade, or when a trader has no free margin. Okay, you don't have any money to sustain that position. You have $100 and you are losing $95 on a trade. The broker has a right to close that trade. They will ask you to top up your account to sustain that position. If you can't top up your account, your broker may have to close that trade automatically, and that's called a margin call. So to prevent this, you use a stop loss, as I have explained. Let's talk about three types of analysis. We have what we call the technical, the fundamental, and the sentimental. These are three ways we determine the direction of the market, because understanding where the market is going to, if it's going upward or downward, is key to your success in this trading. In fact, that's what 80% of the class is all about, knowing when to buy and when to sell. So let's talk about technical analysis. When a trader uses previous price action, okay, to try to determine the future behavior of the market, that is called technical analysis, and that's been done using charts. We'll be talking about this in details later. That's talking about charts and indicators, trying to see the history the market has made in the chart, and try to use the history to determine the future. There's a popular saying in Forex that history do repeat itself, and that's true in the Forex market. So we can look at historical charts and data and try and determine what the future of the price may be. So this kind of analysis is what we call technical analysis. But when we are looking at economy, okay, we're studying an economy of a currency. If, for example, we want to buy into the dollar, we're looking at the economy, we're looking at the demand and supply, we're looking at the production, we're looking at interest rate, we're looking at unemployment claim, we're looking at Federal Reserve policy. This whole factor, they are all fundamental analysis. Okay, that has to do with economy, analyzing the economy, social, political forces that affect demand and supply of an asset. So basically, when you do this kind of analysis, you are doing what we call fundamental analysis. Okay, finally, let me just talk about sentiment. Sentimental simply has to do with the sentiment of the traders. Okay, you and I understand that though there may be fundamental news, okay, there may be news affecting the currency, but the interpretation of the traders and the position they take on how they tend to interpret the news plays a very important role on how a currency movement turns out. And that's what sentiment simply means. It has to do with trying to study what people's perspective about interpretation of a news or occurrence is. Okay, there are some news that you may think that is may affect a currency negatively, but because majority of the traders feels that it doesn't really matter, so such may not really affect the way you think. So but what do? You have to go with the sentiment of the majority of the trader. So sentiment analysis has to do with probably balancing your technical and fundamental based on the behavior or interpretation of what other traders thinks of it. So let's talk about 4 types of trader, because definitely you're going to fall in under 1 or 2 of this category as you begin your trading journey, and as you start trading you may end up being a scalper, a day trader, a swing trader, or a position trader. Now who is a scalper? A scalper are those kind of trader that holds a position for few seconds to few minutes at most, and their main objective is just to grab small amount of pips as many times as they could throughout the busiest time of the day. So basically what scalpers do is that they enter the market and they quickly make some little pips and they exit. So they're not looking at making much, they're not staying in the market at a very long time, they are just trying to scrap, okay, just to take small pips here and there, and at the end of the day they can make something good for themselves. But the day trader, they pick a side at the beginning of the day, okay, and they hold on to that position, and at the end of the day they close that trade either at a profit or loss, okay, whatever it turns out. They just analyze the market at the beginning of the trading session and they hold on to that position and they close it at the end of that day. While swing traders, they hold their trade for several days and at a time, okay. So they unlike the day traders and the scalpers, they can go for 3 days holding a position, a week, okay. And most times they just have to analyze with a couple of hours, okay, most of them every night, some during the day, just to analyze and see if the position they are holding is still valid, okay. This kind of traders are called swing traders. Then finally we have position traders. These are traders that hold the position for months, weeks, years, long-term traders, okay. Another name for them, they are called long-term traders. So they hold a position for a very long time, and as you go up from scalpers to position trader, then the expectation of what you are expecting to make increases. So while the scalpers may be looking at making something like 4 to 10 pips, the day trader may make probably like 50 pips, okay. So you can see what they are making per trade is bigger. Swing trader may be looking at making 300 pips because they are holding their position longer, while position trader may be looking at making above 1,000 pips because this guy is holding his position for a long time, weeks, months, years maybe. So they could make up to 3,000 pips, 4,000 pips, so depend on the move. So I get this question a lot: which kind of trader should I be, or what kind of trader do you advise me to be? But I usually say it depends on your time, okay. If you have a lot of time to spend on the computer, you may as well be a scalper or a day trader, because scalper, for example, they have to be on the system for a longer time because they have to be patient to spot multiple opportunities, okay. So if you are less busy, you can be a day trader or swing trader because you just have to check your trade once in a day, okay. For position trader, if you want to be a position trader, then you must have number one, probably you don't have the time to trade, and number two, you will have a good volume of cash, okay. You must have huge amount of cash, because for a position trader, the trade could be running against you for a very long time, and you need good capital to sustain those position. You're losing position until it becomes a winning position. And for a position trader, they depend more on fundamental analysis, okay. While scalper, day trader, and swing trader, they could depend on fundamental as well as technical, while position trader, they depend solely on fundamental analysis. So what trader should you be? It all boils down to your personality, okay. So you can be profitable in any of this type of trader. Like me, I'm a day trader stroke swing trader, so you could be a scalper or a position trader. The choice is left for you. So having said that, this brings us to the end of introduction to Forex. In the next video, we'll be going to our MT4. I'll be showing you how to use the MT4. MT4 is the platform where we place trade, do our buy and sell. I'll be walking you through on how to use that. Thank you and see you in the next class.